Hi there, traders. This is Brad Gilbert with today's trading action. All right, North American session's over. We did see the dollar just slide to the downside, right? There's a lot of talk about the Fed potentially cutting by 50 basis points, and those odds have gone up a little bit, and I'll show you that in a minute. But you can see here the pressure is off the equity markets. Massive down day the previous day, back to slightly up now, and it takes off all the pressure, especially off the risk currencies, right? Aussie, Kiwi, and CAD. So a little bit of market reprieve, right? And we're getting back to a weak dollar. Now, let's just have a look where this weakness came from. So we had the Bank of Canada rate decision as expected, 100%. And with that, let me just show you, as I was saying, like if they cut by 0.25, the actual Canadian dollar will rally. It won't fall. And that's pretty much what we saw across the board. So you can avoid trouble there if you know what's factored in and what that means for the instrument, right? So a good one to sort of avoid. If anything, that CAD interest rate decision was a non-event. Now, so looking outside the CAD data, right? Now, like I'm telling you, like a good second tier number is the factory orders. And that was sort of pretty much, you know, a little bit of a bounce from the prior month. But this is where you can understand what the market is focusing on. It's all about jobs, right? The non-farm payrolls Friday is going to be huge. These job openings, right? I would probably say they're a third, maybe a fourth tier employment number. But if you look at where the market is looking, right, and it's all about the detail, right? This is just another jobs data. And we saw this during the pandemic. These numbers were 3.5-year lows, right? The job openings dropped to a 3.5-year lows. And the Fed have been talking about employment, right? And so just a second or third, fourth tier number at best, number like that, what does it do for us? Well, I tell you what, it changes the whole perception of what the Fed might be doing. Now, the derivatives market, 0.25%, only 55%, like half percentage point now, 45%. Now, I'm sort of, with my experience, I'm guessing if we go half 50 basis points, it's panic stations. And I think they'll actually buy dollars, right? We're a long way away from the 18th of September, but you got to start to look at where, you know, big sort of cuts like this, it comes back to sort of panic stations. We've got to get things moving because you know what? If unemployment drops and then escalates, it can increase so quickly that the Fed know they've got their hands full. So that can lead to lower global growth and a rush to safe havens, the yen, the Swiss, and inevitably the US dollar, right? So we've got to keep an eye on this as we go closer to the date. This, the result, right? We're seeing like lower interest rate yields here on the US treasuries. So the US equity futures are up. And you know what? You can't see just at the moment, the instruments haven't hardly moved in Asia, but we've got a bit of a risk on profile, right? Just on the short term, right? So we are like this, well, that move yesterday, right? It's just taken out some, as I said, taken out some stale positions. The dollar is recharging for a move to the downside. Same with euro, sterling. I can see Aussie coming back hard as well as the Kiwi and dollar CAD down. You can see dollar yen and dollar Swiss. These puppies here are the sleeping giants and they will kick into gear. If we get weaker US numbers, right, there's going to be a big rush into dollar Swiss, like there's a bit of shift. Sell dollars, buy Swiss, sell dollars, buy yen, right? They're looking to park their cash and avoid major risk, which is what weaker non-farm payrolls would do for us. Okay, so we're building, right? The markets are building up, and it's been a sort of bit of a slow start to the week, but now you can start to sort of piece together a few components as we lead into Friday's non-farm payrolls. You got Swiss unemployment. You got some German numbers there to keep an eye on. Wouldn't worry so much about the Eurozone numbers there. Well, Eurozone retail sales. Like the Eurozone numbers, right? I don't even know where they get their data from. Most people, most bankers would look at the German data for the major edge here, right? And as we come into today's North American session, we're going to find that we've got a whole bunch of these numbers come out all the time, a prelude to the non-farm payrolls. Now, just keep an eye on these numbers because all the employment numbers are now sort of seeing, the interest rate probabilities of what the Fed are going to do change. It's impacting the dollar, et cetera, so forth. So I think it's going to be pretty lively, right? These final S&P numbers, maybe not too much, but this ISM non-manufacturing number, you want to keep an eye on that, right? So today I'd be keeping an eye on the initial jobless claims, maybe the ADP, national employment as well. Anything to do with employment's worth a look. And a little bit later, the non-manufacturing, otherwise called the services data, that is worth keeping an eye on too. So the North American session is building as we go through the week, right? And it's only going to get to fever pitch, especially if we see, some sort of weakness in these numbers here, the jobless claims and the ADP data there. That's going to build tomorrow into a cataclysmic event, right? You're going to have the non-farm payrolls. To me, it almost makes it untradeable because the non-farms and the employment change, unemployment rate, average earnings, it's so lively, right? If we get a number below the lows on Friday, you're going to see it's going to be like a Christmas tree lighting up, right? You'd be like, do I sell? Oh my God, they're running towards selling risk assets. They're buying dollars. Or, you know what? I think the best outcome is a number like, say, maybe slightly lower than the pole, but not below the low, the minimum. And I'll cover this tomorrow because then, we got the weakness and we're going to move back towards a 0.25% cut by the Fed, right? This is like the CPI numbers next week are the key to it, but this is a major component of the decision. And weakness, like there's 100% chance of them cutting by 0.25. It's almost a line ball decision now, whether it's 50 basis points. And that's where Friday's non-farms will come into play. And first of all, we're just going to get through Thursday, and that's the ADP data, right? So just cool your jets. Try and look what's in front of you. Don't get so distracted by what the media is presenting. The ISM manufacturing data is key, right? And then if I had to pick out of the two, the jobless claims, right? Keep an eye on that as well. And we'll see how things play out. It's all eyes on the US dollar at the moment. And so, if you're outside the North America session, try and tune in for some of the data releases just to get a feel of what's happening. Once we know where the market is moving, then it's easy to jump on, right? Equity markets will move well after the data. So you're looking to see whether they're going up or down. The data will have an impact, the employment on the US treasuries, the yields up or down, interest rates, and that'll impact the currencies, right? So you got a little bit of looking to do as we get closer to the numbers. Weak US numbers, weak dollar for the moment. We'll see if it escalates into a major risk-off event because that would see the dollar rally as opposed to fall, even though we have weak numbers. Sounds confusing. It'll make sense to you once you start seeing what happens in the market. All right, guys, have a good one. All the best. Cheerio.